Hello and Happy New Year. Welcome back to this week's Manager's Thoughts. We hope you all had safe, healthy, and restful holidays, and we're super excited for the new year and super excited for what the market might look like in the new year, so let's just get right into it. Alrighty, so as we wrap up the first trading week of 2023, markets are really just focused on if the Fed can accomplish a soft landing this year, next year, or whenever it would be. And so the biggest questions going into this new year are we going to have a recession? When would it start? How long of a recession are we looking at? How deep of a recession are we looking at? And so this is really what investors are thinking about going into this new year. This week, though, equities were up. For the short week ending Friday, January 6th, the S&P 500 was up 1.86%, the NASDAQ Composite was up 1.76%, and the Dow Jones Industrial Average was up about 1.5%. And so as of Thursday, also the 10-year U.S. Treasury yield was down about 2.1% for the week so far. We'll just look forward to continuing to monitor these markets and then just kind of go into some economic news next. Alrighty, so moving into some economic updates of this week, kind of the main headline this week was the jobs report on Friday morning that came out from the BLS. And so we saw non-farm payrolls increased about 223,000 in December. And so not only was this above the 208,000 expected, but it also was down a little bit from November's gain of 256,000 jobs. And so more importantly, though, the unemployment rate dropped to 3.5%, which is historically very low, not seen since before the pandemic. You can see that in the chart there. It came down from November's 3.6% unemployment rate, and it was also much lower than the expected 3.7% unemployment rate for the month of December. And so this was definitely big jobs data week. And so we look forward to keeping track of these data points. Alrighty, so in addition to the non-farm payroll that we got, as well as the unemployment rate, we also got average hourly earnings this Friday morning. And so month over month, we saw a 0.3% increase from November to December, which was below expectations of 0.4%. And then kind of on an annualized rate, this was about plus 4.6% in December growth year over year. And so markets were really encouraged by this report, with both wage growth slowing down as well as the labor market remaining pretty tight with low unemployment. And so in reaction to this on Friday, the S&P was up almost 2.3% just in the day in reaction to this positive news. In addition to the jobs data we got on Friday, before that we also got our weekly initial claims data on Thursday, and so came in at 204,000 initial claims, 9.3% below the expected 225,000 claims. So just another data point to support the narrative of a really strong labor market we have here. Is the Fed going to focus on this? Is the Fed going to focus on the slowing wage growth? We're not sure, but definitely important data points to keep track of as we look at what the Fed might do in this new year. Kind of related to the jobs data, this week we also saw a bit of tech layoffs begin into the new year, and so we saw Salesforce lay off about 10% of its staff, Vimeo laid off about 11% of its staff, and Amazon will lay off about 18,000 employees into the new year. And so this continues. Layoffs already seen that we've been tracking with in companies like Meta, the recently taken private Twitter, Uber, Lyft, and many other tech firms. So investors are really eager to see if these layoffs are actually going to have a meaningful impact on earnings as we begin this Q4 reporting season soon, or if it's going to impact the jobs data in the coming quarters too. So it's definitely going to be interesting to see how these play into the economy. On Wednesday, the ISM Manufacturing Index reported the index at 48.4, which was about on par with expectations. It was a bit lower than the November reading of 49, so you can see in the chart there that these are kind of the lowest readings since the initial pandemic drop of 2020. And so with two readings under 50, technically, this economic indicator is kind of giving a little bit of contraction, at least in the manufacturing industry that this tracks with. So it does show a little bit of economic contraction, slowdown in the manufacturing world, but definitely just one of many data points that we're always looking at. The first week of 2023 was definitely not a quiet one. So we saw significant moves in the labor market, with wage growth coming in short, unemployment falling to 3.5%. We saw layoffs continue in the tech sector. We saw the ISM Manufacturing Index come in below 50 for the second month in a row. And so a lot of crazy things going on as we start the new year. So Amidst all this, we are really looking forward to continuing to monitor all these geopolitical events, corporate earnings, the Fed, interest rates, and inflation, as we always do in this new year, just to best manage each of our portfolios. So we're really excited next week to see as Q4 earnings start with some of the big banks, as well as the December CPI data come in. We're always monitoring it and managing our portfolios accordingly. We really appreciate you guys tuning in to Manager's Thoughts. We look forward to providing you many more updates in the new year.